A common belief across the financial world is that when a company buys back its own stock, every remaining investor automatically gets richer. The logic seems obvious. Your individual slice of the pie gets bigger. Yet the total value of the business can stay exactly the same. To see how this happens, we have to establish a strict baseline of corporate accounting. The total value of a business remains completely static, even as the internal distribution of its ownership shifts continuously. This diagram illustrates a simple company valued at 1,000 units of money. It is divided perfectly into 100 shares. That means each individual share represents exactly 10 units of value. Now assume the company decides to take 200 units of its own cash and use it to buy back 20 of its shares from the open market. Those 20 shares are retired. The total business is still worth 1,000 units because it simply moved 200 out of cash and into reduced equity. But with only 80 shares left, the math changes. We divide the 1,000 total units by 80, and the per share value mechanically rises to 12.5. At first glance, this looks like pure profit. A share that used to represent 10 units now represents 12.5. But this impression of sudden wealth requires us to ignore the opportunity cost of the cash the company just permanently surrendered. Consider what the company gave up. Those 200 units of spent cash are gone. They can no longer be used to purchase new machinery, hire new talent, or be held as a safe buffer during an economic downturn. The business did not expand its operational footprint. It did not capture new market share or invent a new product. It exclusively removed ownership units from circulation. The psychological trap is simple. Investors see a number going up and mistake the pure arithmetic division of a fixed pie for actual economic expansion. A buyback is strictly a mechanical substitution on the balance sheet. It is an exchange of internal assets for reduced equity, rather than an engine of genuine business growth. Let's escalate the scale. This asset model shows a larger company worth 5,000 units. It has 500 shares, and it sits on a significant pile of cash, exactly 500 units. The company decides to allocate all 500 cash units to retire 50 shares, bringing the total share count down to 450. Dividing the remaining assets by the new share count yields a per share value of 11.11. On paper, that is an immediate 11% gain per share. But we have to account for the lost opportunity cost. Before it was spent, those 500 cash units were earning a modest 6% annual return, generating a steady 30 units of yearly income. After the buyback is fully executed, those 30 units of yearly income completely vanish from the company's future cash flows. Here is the direct contradiction. The value per share rises mathematically on paper, while the actual underlying earning power of the business falls. Sacrificing productive cash strictly for share reduction makes the business operationally weaker. It severs the link between earnings per share and the true operational health of the company. Analysts frequently treat share repurchases as mathematically equivalent to direct dividend payments. The assumption is that value leaves the company and goes to shareholders either way. Here is a comparative model tracking a firm with 1,000 units in profit. It faces a choice: distribute it all as a dividend or use it to repurchase shares. On the dividend pathway, the mechanics are straightforward. The 1,000 units are distributed equally across 100 shares, guaranteeing an immediate and certain 10 units of cash directly to every shareholder. On the buyback pathway, the 1,000 units loop back into the corporate structure to destroy 10 share slots. The remaining 90 shares now hold a higher theoretical claim on future earnings, but the shareholders receive no actual cash today. The structural difference lies in timing. A dividend is an immediate, realized gain in your pocket. A buyback is entirely indirect, and it carries a hidden variability. Buybacks are executed at fluctuating market prices. If the company buys when the stock is high, that same pool of money will retire far fewer shares than if they buy when prices are low. Unlike the ironclad certainty of a dividend, a buyback introduces an unpredictable timing risk. The actual benefit to the shareholder is entirely dependent on the chaotic, daily variance of the open stock market. The math becomes actively dangerous in a third scenario: executing share buybacks entirely funded by taking on new corporate debt. This diagram shows a company valued at 2,000 units. It issues 400 units of new debt specifically to buy back and retire 10. Watch the initial arithmetic illusion. Even if total earnings stay completely flat at 200 units, dividing those earnings across the newly reduced share count pushes earnings per share up from 1.0 to 1.11. Total operational earnings have not changed by a single unit. The perceived improvement is entirely an artifact of pure division. But the company introduced a strict new constraint. Those 400 units of newly issued debt carry a mandatory 7% annual interest rate. We have to subtract that 28 units of interest from the 200 units of operating earnings. The true net earnings drop to 172. When we recalculate the reality of the business, we divide the new net earnings of 172 by the remaining shares. The earnings per share collapses down to 0.95. Financing buybacks with debt destroys shareholder value. It simply rearranges equity claims while introducing a permanent structural liability that quietly drains the company's future income. The deepest systemic failure of buybacks occurs when market prices are not neutral, when a company executes a buyback during a phase of massive overvaluation. This chart compares a valuation spread. Assume intrinsic share value is 8 units, but market price is 10. Using 100 cash units to buy inflated stock captures only 10 units of true value. The remaining 90 units permanently leave the company. This massive destruction of corporate wealth is completely invisible in standard headline EPS reporting. Buying overpriced equity actively drains real intrinsic value from the shareholders who remain. The company is left tangibly poorer, even while appearing arithmetically stronger. When we step back from the individual balance sheet and look at macroeconomic cycles of boom and bust, a clear asymmetry emerges. This timeline tracks aggregate market behavior. During economic expansions, buyback volumes consistently surge alongside high cash flows, artificially reinforcing steep increases in stock prices. But during economic downturns, when shareholder support is actually needed, buyback activity entirely disappears. The mental model that a shrinking share count means each remaining share is inherently more valuable collapses when subjected to real-world stress testing. Buybacks are not a value creation engine. They are strictly a capital allocation mechanism that alters how value is divided, realized, and financed. A share is not a growing asset by default. It's a claim on a shifting pool of assets, completely reshaped without ever expanding. Investors must rigorously analyze the math, determining if a shrinking share count signals genuine operational strength or if it merely masks a rearranged, heavily financed fragility.